Hi, this is Michael Waits, and welcome back to InsurTech Amplified. We are joined today by Nakita Devlin, founder and CEO at Rick Insurance. Nakita, thank you so much for coming to the show. Let's give our listeners a little bit of your background just for some context before we start.
Sure. Hi. Thank you so much for having me. Just a little background on myself. I've been in the insurance industry for almost 15 years, starting out as a broker and then moving over to the technology side, and then eventually founding my own InsurTech climate-focused MGA.
I love it. So let's start with a really big question. What should insurance do for people? Like, what's the point?
I think at the minimum, insurance should deliver on the promise that they say that they're going to deliver on, which is being this financial safety net for someone. I think where we find ourselves in 2025 is that the idea of what a financial safety net is for an individual living through climate change has changed. We see incredibly long wait times for folks to go through the claims process, and just the way people's financial infrastructures are at a personal level have changed. Those long wait times have become an increasingly big problem for folks, waiting months, almost a year to receive payouts after a big climate catastrophe. And those payouts, that they might use to rebuild their home, they might need to consider rebuilding their home somewhere else. So I think that what insurance should solve is, how do we create a good, stable financial safety net for someone whose, life savings might be invested in their home or the property in their home. And I think that that's really the answer we should solve. And we should start thinking really differently about how we address that problem and concern in 2025 for, renters, homeowners, small business owners. I will say that I've primarily worked in the commercial space. And I will say that in the commercial space, we've seen the evolution of policy terms and the way that, recovery is structured for large corporations. There's really an opportunity now, at least stateside, to really start looking at how do we adopt some of the policy language and policy forms that have always worked really well for the commercial industry, and sort of, let's start seeing that happen more on the renter, homeowner, small business side in the US.
You said this a couple of times, but what's changed in the sort of homeowner space that's made the payouts take so much longer now? Is it just happening more often? I mean, I saw all the news on the fires. I don't live in the United States, but I do follow the news there. The rest of my family's there, right? So I follow all the news. But is this just happening more often? What's driving this idea that it's just taking so much longer to make these payouts?
I think so. That's a really big question, and I think there's so many facets to that.
I got time.
I think the frequency, climate change is making these events happen at a more frequent interval, and the severity is higher. And at the same time, we've seen sort of the shrinking of the middle class in the US, where folks don't necessarily have a huge savings account that they can tap into while they wait for their insurance payout. So the need for rapid payouts is increasing, while at the same time we have this pressure of the frequency and the severity of these climate catastrophes happening. So, maybe 50 years ago, you would have been able to maintain tap into your savings account and get through while you wait for your claims payout. That's not really the case now. We've also seen a shift in home ownership. There's a large, demographic of renters in the US. So there's this shift in how we manage ourselves financially. And I think that insurance has not necessarily caught up to that. And at the flip side, when you look at insurance technology, where you've seen InsurTech, progress in the last few years, InsurTech as a coined phrase, really early on focused on data and the claims process and, shortening that. But really, we haven't seen it shorten the life cycle for the average consumer that much. It might have shortened it on the insurance carrier side, that maybe they're getting an influx of data more rapidly, or they're able to manage the process a little bit faster. But we're still not seeing the payouts being sent to the individual recovering any faster than it has has over the last decade. So insurance companies will say that they've gained efficiency, right? And they might be able to create better projections, but I don't know if the average homeowner, renter, or small business owner is saying that they've seen the upside of that increased technology or increased use of data.
Can we talk a little bit about homeownership just so the listeners can get educated and maybe I can get educated as well? When I was a kid, my parents owned a house. You'll laugh at this. I think they paid $19,900 to buy their house. They sold it at $25,000, if I remember correctly, and they were super happy because it went up in value, right? And what is that, like 33%, if my math is correct? That's awesome. But now, if you buy a house for $400,000 and it goes up 33%, now it's like $500,000, and it seems to me, at least based on the news that I heard, it's just becoming unaffordable. Is this part of like the change that you're talking about, where maybe just the home prices are just getting so expensive, which should be a good thing because it's like the biggest investment most people make, but it's actually a bad thing because it's affecting the insurance premiums and then impacting the payouts? Because if a $150,000 house burns down, from an insurance payout perspective, it's not fatal. But if a $2 million house burns down, it's just way more expensive to rebuild. Is this part of the problem as well?
I would say that part of the problem is how, and this is not the problem, part of why we're seeing a struggle here is how insurance is priced, in the sense that like homeowners and their relationship with insurance companies are not really pricing for a total loss. But because climate change is impacting us, what we're seeing is that there are more total losses happening across the board for homes than we originally thought that there would be. And while this total loss is happening, it's not just happening to a single home, it's happening community wide. And there's market pressures happening when community wide you're looking to rebuild. And all of a sudden the price for all the goods associated with rebuilding your home have skyrocketed. There's not enough labor available to rebuild your home you would hope that if you had to rebuild your home from scratch, that you could potentially put additional safeguards in your home and build it to a higher code than you previously had. And because there's such a lack of labor post these catastrophes, oftentimes homeowners are being, tasked with the decision of, do I rebuild my home faster, or do I wait a year and a half and put on a roof that might be able to withstand a hurricane more, and wait for the labor to become available for the contractors who know how to, work with those types of equipment and that type of physical goods. And I think that this is, once again, it's an opportunity that I feel like the insurance industry could have picked up on maybe a few decades ago, really start implementing, not to be harsh on them, but
Fair enough.
Right. I think that there was an opportunity maybe 30 years ago, let's use roofs for an example. You can harden your home and put on a better roof to better withstand hurricane impacts. And insurance policy languages really should have been adapted, where we're giving people who have to rebuild their home the adequate financial capabilities to do that, but also the support to do that, in terms of like crafting policy language that will allow them to do that more easily and supportive through the insurance policy that's there. So we're really meeting at this intersection of where insurance regulations, insurance policy language has not caught up to the demand and the need of what's happening out in these communities.
So one of the earliest recordings that we did on the InsurTech Amplified podcast was with the founder of WooE, right, which is a company that just tries to build resilience into the entire process. And this must have been over 2 years ago now. And he did spend a lot of time talking about like hardening your home, but hardening a bunch of different things, right? Like building better structures, but also like changing the way you deal with the foliage and all the stuff that's around your house. This has to be super important too. Is there a parametric sort of solution to any of this as well? And do we have like guidelines we can use from other places where it's been successful to try to implement that too? And I've been talking to companies in Europe about parametric insurance now for 4 years at least, right? And some of it's working there in the climate space, but I'm just curious what your perspective is. And just to add a little bit of a wrinkle to it, right? Because you say they're not pricing for total loss. it would be good, at least in my mind, to have something that I like to call para-indemnity insurance, where like there's a parametric payout right away. You get 10 grand, you get 15 grand, you get 20 grand. So at least you can survive in the interim before you get indemnified for the rest of the loss. Anyway, I know it's a long thing, but maybe you can talk about that in some context as well.
I think that one might be the easiest one to tackle. What would happen if we shifted every single renter, homeowner, small business policy to include some parametric payout? I think that why we haven't seen the proliferation of that is that there is a regulatory hurdle. Indemnity policies, as you know, you need to prove that there was a loss, whereas the parametric policies, it's looking at a third-party trigger that's activating a third-party data source that can be the activation for the policy. So that would require, I think, a big regulatory hurdle to shift ourselves to this future state where every single insurance policy that's being sold in the US has some kind of parametric trigger in it. And while I would love to see the future state of that, I think if we're living in the reality of where we are right now, I think where we probably need to start is where, at least from my perspective, where Rick is, where we're building these micro parametric policies that are really easy to access, but also don't stop you from continuing on to get, full-blown insurance for indemnity insurance for your household or for your small business. And these types of products have always been available in the commercial sector. I do not come from a place where parametric insurance is the end-all solution. It's a piece to the puzzle. And at the commercial level, we've always known that for many, many years. And where I would like to point us is that we've seen parametric programs work really well in the Caribbean, globally, in Asian countries, and across in Europe too. I would say that why we're not really seeing that happen in the US is that oftentimes these parametric programs are being purchased by true experienced buyers of insurance, they're risk management experts, and they're able to do it at the state level. I think where there's opportunity in the US is, because the U.S. is regulated, each state in the U.S. has its own insurance regulatory department, which creates...
Seems a little bit insane as an outsider.
Right.
Seems a bit insane, but fair enough. Those are the rules, right? Like that's the system that exists. So fair enough. Yeah.
Right. And when you look at parametric insurance that has been purchased globally at the country level, oftentimes these payouts are similar to what you mentioned, a $10,000 payout, a $5,000 payout meant to infuse rapid cash into a community that's recovering from catastrophe. So it's not just a regulatory hurdle in the US, how the insurance value chain is structured is that in order to offer these micro parametric policies in the US, they need to be affordable and low cost. So you need a technology component to completely streamline the entire process because these are small value policies that are affordable, and the insurance value chain the excess and surplus lines insurance value chain has not always been great at selling really affordable policies. Having worked in that space for a long time, for you to work with an excess and surplus lines carrier, a lot of times there's, it's not well published, but there's minimum policy premium requirements starting at $10,000. So if you're talking about an average homeowner accessing the excess and surplus lines area where they might get a parametric flood, earthquake, wildfire policy, they don't have $10,000 to, access that type of policy. So you really need technology and you need a new product type to be built. And building the technology, I think we're there. I think we have that. I think building these new product types needs regulatory support and just market awareness for these types of products for the average consumer. So those are some of the problems that we're looking to tackle with what we're doing with Rick. But we see this massive, massive opportunity to start addressing climate concerns at the renter, homeowner, small business owner level with these micro parametric policies that we know can work, but just need a better distribution pathway.
Can we dig a little bit deeper into this excess and surplus and like what kind of tech is necessary? And the reason why I'm asking is because for me, the tech scales when like there's product standardization, right? So like for auto insurance, it should be not really simple, but much simpler to build a tech platform that sells auto insurance, because if I buy this particular car and you buy that particular car and we're the same age, we have the same driving record, like 3 million cars get sold every year, maybe 7 million in the United States. I don't know the numbers anymore. And these auto policies are pretty standard. That will change when autonomous driving comes, but let's not talk about that.
Yeah.
But in excess and surplus, my feeling is that, and that's when the car companies become insurance companies, but let's leave that for another time. But in excess and surplus, right, like every individual situation could be different. So how do you build technology that scales, but still makes it possible to impact what's happening in that market? And maybe you can talk to me about what you've built so I can get a better sense for it.
Yeah, absolutely. So, all right, that was like a big question. And
There's a lot there.
Yeah. I will say that the technology you need to support the excess and surplus lines vertical in the industry, and where we found ourselves is our platform is, every platform has API access, but all of our components are microservice based, which means that we've built into our platform the flexibility to have multiple API calls into the service that we need in order to underwrite that policy. So it's not a manual process anymore. We can completely streamline and make that process incredibly efficient, but still give that unique policy to our customer. The other aspect of managing all of this, and your listeners are, they live and breathe insurance, so some of this jargon I know that they'll be able to get for excess and surplus lines types of business that are addressing climate change. You really have to be able to monitor aggregation in real time. You need to make sure that your partnership deal that you have with your reinsurer, that you're not out of bounds with that you're not overriding policies in, let's say, the coast of Florida. So built into everything that we've done is real-time aggregation monitoring of accumulation. So we can turn off and on the spigot depending on what state we're working in real time. But I think in order to best operationalize working with the insurance industry is that, you want to work with multiple reinsurers. So to be able to manage that spigot for multiple reinsurers at the same simultaneously, you need to be able to really do that with technology. A single person shouldn't be looking at that. You shouldn't be waiting for an email from your insurance carrier saying, "Hey, there's a storm headed to you. You need to turn off the spigot." We should be watching that ourselves and notifying our reinsurer, "Hey, we see that this is barreling down. We're ready, and we can turn off this spigot whenever as soon as we hear from you." So I do think that to work more closely and more deeply with the excess and surplus lines portion of our industry, you need to have that built into your framework of your technology stack.
What is the impact on the actuaries that are, I don't want to say actually, but that are pricing this stuff up? And as an MGA, right, it's kind of a hybrid insurance company, right? Because you have pre-approval on capacity as well. So you can turn on and off that spigot, but what's the impact on the actuaries, and how does this impact MGAs in a way that it doesn't impact a general insurer, if you know what I mean? Because it's a different animal, yeah?
Got it. So, and I'm not an actuary by trade. That's where my co-founder comes in. He has a lot of
Neither am I.
expertise there. But what I will say about how this impacts them, I think from an MGA standpoint, especially if you're working in the climate space, it's really, you should have a goal of working with as many reinsurers as possible to sort of balance that risk across the board, because their portfolio is so much bigger than our portfolio of risk that we're looking at. So I will say that, being able to highlight back to your reinsurer that you've done a really good job with pricing your risk, it will give them the comfort to, participate in your MGA and your reinsurance stack. So so you were talking about actuaries, and then there was another part to your question.
Yeah, just what's the impact on an MGA that's different than an impact on a general insurer, right?
Right. And I can't speak to that completely broadly. I can speak to what Rick does and what we do that's a little bit differently
Please.
than other MGAs. So we look at meteorological data versus a lot of MGAs who are working in the climate space. They're looking at individual risk characteristics of each home, each small business. And they, as a result of that, you have an incredible amount of variability depending on the degree of reliability that you have on your data. And then that sort of that question mark on the reliability of your data feeds into the model, and it can, it raises questions around how certain is your model, and then that impacts your relationship with your reinsurer. Versus what Rick is doing, we specifically look to just build our products around meteorological data, which we have a wealth of, right? Like our first product market is a rainfall flood product, and we have 300 years of rainfall data that we can look at. And we think that that's serving a dual purpose. It's giving comfort to our reinsurers, who that's going to be our most important relationship going forward. But it also gives a transparency to the customer that we're looking to work with. Because again, in the commercial sector, you don't really have to give that transparency to your commercial customer, because they have a long-standing relationship with you. They understand how insurance works. But if you want to work with a renter, homeowner, small commercial business owner, there's not a lot of trust there for the insurance sector. And if you can point to meteorological data, and if you can point to your policy activation trigger through the National Weather Service, which is what we have in the US, I think it creates a layer of trust and transparency that you need in order to build that relationship with the customer to be able to sell your micro parametric policies at scale. So when we speak to our reinsurers, we think that we can give them a level of comfort with our data, but also with the idea around that we've created a product that actually fits the average consumer, because the modeling is not happening in this deep black box that, creates a sense of concern for the average consumer. And I don't want to get too deeply into it, but we've seen in the US that this is becoming a troublesome thing for customers, the use of AI and some of that, the modeling. And I think that as we go forward, a trend prediction, if you will be
tell me.
transparent data sources that the average consumer can tap into and feel a sense of assurance, if you will, that their policy is working exactly the way that they expect it to.
So do you want to talk at all about predictive AI, in whether it's in the weather space or just in the pricing space at all? Just because it's almost like the elephant in the room, whether it's generative AI, general, just typical artificial intelligence, or predictive AI, it's going to impact every business, no matter what. It impacts mine. I'm sure it impacts yours. Do you want to talk at all about at least what those discussions are around this internally, and how you think it's going to impact the way business gets done?
Sure. And again, no one's an expert on AI. And if they tell you, if they tell you stop listening to them.
Exactly. Stop listening. I'm just curious what you're thinking. I know you're talking about it internally, right? So there must be some conversations, and I'm just curious what the perspective is more than anything.
So for us, because again, our products are built really differently than a traditional flood policy or a traditional wildfire policy, even traditional parametric flood and wildfire policies. We are really just looking at that meteorological data, or we're looking just at that weather data, because we think that a lot of those factors sort of unfairly impact our customer. When they were building their house 30 years ago, they didn't know that they needed to build their homes to meet the climate that we have right now in 2025. And it's sort of doubly punishing someone for their lack of knowledge. So if we're looking at just meteorological data, we price to those meteorological events that we know are going to happen. And as a result of that, we have been looking at AI companies to look at predictive weather models, but we're not looking in terms of ingesting it into our model for how we price. We're looking at it in terms of how can we use predictive weather models to confirm back to our reinsurers that our book of business is going to perform the way that we expect it to. So absolutely, we are having those conversations. That's how we are looking at potentially ingesting and working with some companies that offer those services. We're not looking to build that ourselves. We think that there are plenty of really great experts out there that we will be able to leverage that information.
I had a whole conversation today with a guy who was talking about quantum computing and the impact that it was going to have on financial services. I'm not going to ask you about quantum because neither you nor I are even close to being it, unless you're some kind of quantum physicist, and I just don't know that. It wouldn't surprise me. But it was just really interesting the way he was presenting like what the impact is going to be on risk management and also on calculations for risks across the board in the entire financial services industry. So I can't stop thinking about it because he was actually kind of brilliant. Do you want to talk a little bit about distribution as well? You kind of hinted at it at the beginning of this conversation a lot. You're right. When I first started doing both the Asia InsurTech podcast and InsurTech Amplified, a lot of the startups out there were talking about how they could have alternative forms of distribution, but not a lot of people are talking about it now. Has stuff changed? Like what's going on and what's going to happen in 2025?
Well, I think so let's talk about what's changed. I think early on stateside, and I think in Europe too, where we've really seen these insurtech companies come in and say that they had a role to play was in shortening the claims process, make sure that helping insurance companies, not pay claims that they're not supposed to. And I think that there was a lot of hope from these insurtech companies that they would, and some have gone on to do this, some have not, that they would continue on to be acquired by a large insurance company when they've sort of proved out their technology and their platform. And we really haven't seen as much of that as I think the startups hoped that they would see. And as a result of that, we have to shift the conversation back to distribution. So, okay, if major insurance company A is not going to buy me, how do I start taking on some of that risk by forming myself as an MGA and selling these policies, because I have trust and faith that my model and my technology is actually going to work the way that, I think that it's going to work. So we've seen where I'm starting to see a shift happen is that some of these data first, technology first companies are shifting into how do I formalize myself as an MGA to sort of see the upside on writing those policies that I've been providing to these major insurance companies. And I'm not sure where this is going to land in the next couple of years, but I think it's a very interesting time to see who sort of makes it out of this shakeup. We have always been, again, my co-founder and I have been in the industry for 15 plus years. Our goal was always to formalize ourselves as an MGA with a focus on the distribution. I came from the sales side of insurance, and I think that where there's the most amount of opportunity is on increasing distribution. And I don't think that necessarily means that you need to rewrite and reinvent the wheel here. I think there's a lot of really good pathways already carved out that we can leverage. And one of the things that Rick is looking to do is that we're bringing our product to market as an employee benefit. So it's a micro parametric insurance that you can't go to your local broker and purchase. You have to get it from your employer. And where we have found a couple of things we had to manage as we were looking at that distribution point, which is our policies are incredibly affordable. They're $168 annually. So in order to scale a company when you're selling $168 policies, you need to sell in bulk. And we've found massive alignment with working with employers in communities that are experiencing climate change. And it's twofold. The employers, their workforce is their bottom line, right? Like they can actually see an ROI on if they can get their workforce back to work post catastrophe. And to start, we're targeting the healthcare, the manufacturing, and the municipal sector, which those often tend to be the largest workforces in every community. So we think that there's a massive alignment there to sort of leverage those existing distribution channels that are really well carved and heavily supported already with technology. When someone is going in and selecting their health insurance for the year, that's, most people are doing that on their desktop, right? Like you're doing it at work on your desktop. So these companies have already been using APIs and connecting to third-party vendors for years. And, I think that there's a massive opportunity to leverage some of that connectivity. And what I will say that we've also been exploring is community-based insurance, being able to sell. So for some communities, at the municipal level, there has been a lot of chatter in the US around what would it look like if the community purchased parametric insurance on behalf of the residents living in the community.
Interesting.
Yeah. We find ourselves at an interesting time in the US in the sense that there's some political changes that are happening here that might stall that development.
Are there?
Right. Which you're right. I don't want to we could really get sidetracked if we start going.
Yeah, let's not get sidetracked. I just love the way you say that, though. Small political changes taking place. Go ahead.
When you start talking about selling into a community, that's still group distribution insurance. It's still municipality holding the policy and all of the homeowners or the renters in the community hanging off the policy, which is group distribution. So we think that there's this really solid opportunity to look at existing group distribution pathways that are well worn and see what we can build upon as we, bring our products to market. One of the other things that we've noticed is there's this interconnectivity between climate catastrophes that are happening in communities. Like I said, our first product is an extreme rainfall product, but extreme heat and extreme rainfall are happening in conjunction. We know that there's cycles of extreme heat that lead to extreme rainfall. So as we're working with employers or at the community level, whichever group we're working with, we know that there's a demand to create parametric climate products that address all those needs. So we are building extreme rainfall. We're looking at extreme heat, which we've actually partnered with InsurTech New York to build our extreme heat product because there's a decarbonization element there. But we think that being able to work with it, if you want to effectively work with a community or a group purchaser of insurance, you need to have a suite of products that you can offer to that community or to that employer, because extreme heat, extreme rainfall, wildfire, they're all going to happen in cycles. So you can't just offer a single product. And I think that we're going to see more of that happening in the US.
Is there, because you talked about employers earlier, is there an SME distribution channel here as well, in the sense that something like 45% of the US economy is SMEs and SMEs, small businesses, essentially, right? You can call them whatever you want. And employment kind of mirrors that as well. So is that another way of, instead of just going to like all the big companies and using that as a distribution channel, using the SMEs as well?
Absolutely. Absolutely. There's massive opportunity there. And where there's a wealth of data here because, health and benefit companies have already been working with these SMEs. So it's a well-worn path. And you see a better take-up rate if you're working with these SMEs, because you're allowed to get in and talk to their workforce a little bit more closely than if you're working with a big, large employer. So I think that where we find ourselves is what Rick is doing is we're looking at distribution, not just from like what technology do we need to support it, but what marketing efforts do we need to support it. And I have a little bit of a background in marketing technology, and that has been something that I found very incredibly valuable as we, push forward as a company. We're also looking at, again, insurance is heavily regulated in the US, so you're not allowed to really market directly. If you're selling an E&S product, you're not allowed to market directly to your customer where they can hop onto your website and buy it directly. But we do see an opportunity to run awareness ads through social media campaigns where we're just educating the customer rather than offering the product. So the employer will remain the pathway where they can purchase the product. But we've built into our strategy a way of getting out there and educating our customer ahead of open enrollment so that they're really well primed to make the best buying decision for themselves. Because open enrollment in the US is really just like 5 days long. It's not a long period. And you're competing with a shelf space across really important products. Medical insurance is incredibly important in the US. So to be able to stand out and have your product shine during that time period, we think that when you look at distribution and you look at marketing, you cannot, if your plan does not include getting to your customer through, at any other time than those 5 days, I think you're going to have a problem scaling your product. So we think we've come up with some really nifty ideas around that.
That is awesome. Is there anything else that you want to talk about? This has been an incredible conversation, and I'd like to thank you, unless there's something else you want to hit that we haven't hit already. Is there?
No, I don't think so. I think we covered a lot.
Nakita Devlin, the founder and CEO at Rick Insurance. You were awesome. I really appreciate your time, and thank you so much for doing this.
No, thank you. Thank you for having me.